Welcome to the Embassy Financial Accounting class.
Alright, welcome to class. I want us to understand these terminologies in accounting because they are going to serve as a background to what we will be learning in class. Number one, our assets. Our assets are basically the things owned by a business, e.g., your car, your building, your furniture, even your cash, your money in bank, etc. Basically, they are things that you own and you don't have to return back. What are your liabilities? Your liabilities are basically the things you owe, the things you owe in a business and you have to pay back. Example, your creditors. They sold credits, they sold goods to you on credits, you have to pay them back. Your loans, you collected loans on credits, you have to pay them back. Now, your capital. This is what is left to the owner of the business. It's also called your equity. That is the money you use to start a business, the money you put in between, and the like. You'll learn this later in class. Your balance sheet. This shows the financial position of the business. Now, this puts the asset and the liability on the table and it balances them together. Now, your income statement, also known as your profit and loss account. This records all income and expenses. Alright, so having mastered those terms, let's look at this simple formula. Our asset is now going to be equals to our liabilities plus capital. So let's do simple math. Now let's look for our liability. Our liabilities, I'm making this mistake. Liabilities is now going to be assets minus capital. Then example. Now, like I said earlier, assets are the things you have, liabilities are the things you own, and equity is what is left for the business owner. Now, let's say I have a car worth 50 naira. I have a building worth 200 naira. I have a machine worth 600 naira. My physical cash, I have a cash of 20 naira. I have 400 naira in bank. If we total all of this will give me my total assets. Remember I said assets are the things a business owns. So this is going to give me 1,270 naira. What I can show from calculation 1,200. Now I bought some goods on credit I bought some fabrics. Okay, I bought some fabric on credit from, let me see, 200 naira. I collected a loan from my bank at 50 naira. Sorry, I didn't even add my naira signs. Okay, I I got an overdraft. I think you should know that overdraft is the excess money you withdraw from your account or you collect from your bank that is more than your balance. So let's just divert a bit. So let's say I have 500 naira in my account and I withdraw 700 naira. The balance of 200 naira is my overdraft. So that is what we mean as bank overdraft. So let's go back. So bank overdraft of 350. Now let's sum this up. Our total liability is 600 naira. Now, if I want to get what my capital is, I will simply, from this formula here, my capital will be my asset 1,270 minus 600 naira equals to 670. So let's assume I know what my capital is. I don't know what my asset is. We can use this formula now. Asset equals liability plus capital. So let's say my asset equals liability plus capital. Now my liability is 600 naira plus my capital 670 naira equals to 1,270. Oh, let's say I don't know what my liability is. Let me just create a small space here. Now let's say I don't know what my liability is. The formula for liability says asset minus capital. So let's call our liability L. Let's call our asset A. Let's call our capital C. Our L is what? We don't know. L equals our asset is 1,270 minus our capital. Granted our capital 670. The balance 600. Okay, let's look at this account for this pure water factory. The first thing I want us to do now is I want us to classify this into our assets, liability, and capital. Before we now go further to create extract a balance sheet from this. Okay, so this first one, obviously, is our capital. It's already named capital. Now this equipment is what? Yes, our assets. This creditor is what? Sorry, I think my hand is not so straight, so let me just draw lines to them. Okay, yeah, these creditors now is what? Yeah, correct. Our liabilities. This stock, yeah, correct. It's our asset. It's what we have in stock, part of the goods we have in stock. Our cash, yes, our cash in hand, our assets. Bank, yeah, the money we have in bank, also our assets. Then, yeah, loan from bank, yeah, correct, our liabilities. Now, it's nice that we have been able to classify this. So now I want us to have an extracted balance sheet for this pure water factory. Let's call the name of the pure water factory AD. So, extract balance sheet for AD pure water factory as at 31st March 2026. So let's put our naira sign up here. so I can capture every other figure we'll be putting under. So the first one, our capital. Our capital is coming here. 130. The next one is our equipment. Our equipment is an asset, it's coming here. 90. The next one is our creditors, liability. So let's put our creditors. Our creditors is coming here. 9,000. Our stock is an asset, it's coming here. 15,500. Our cash, the cash we have in hand, also coming as an asset. 50,000 naira. Our bank, the money we have in bank, which is also an asset, is also coming here. Then a loan from bank is a liability, so it's coming here. $20,000. So it's time to sum up. Before that, I want us to notice something. We'll notice all our assets are coming here. All our liabilities, they are here. Capital, in my own opinion, even though it's the company's equity, I still call it a liability to the company. Why? Because it is what the owner owns from the company. I don't know if you get what I'm saying. It is not the company's own per se, it's the owner's share in the company. So the owner can decide to sell part of the shares and the likes. That means their share capital is reduced, and so the capital, me in my own terms, I say it's like a liability to the company, even though we call it the equity, because it is the owner's value in the company. It's the owner's own. I hope you understand. So let's sum this all together. 130 plus 9 plus. Alright, so I want us to notice that I put our liabilities here, I put our assets here. Somebody will ask me, like, why is the capital here? Is the capital not supposed to be part of the company's assets? I will tell you why. Remember, we said earlier that our capital is also called the equity. It is the owner's share in the business. Now, usually when a company is formed, we have, depending on the size of the company, we can have some numbers of shareholders, we can have a single owner. Now, the shareholders or even the owner can decide to withdraw part of their capital from the business at any point in time. What happens? Like I said earlier, our liability, it is what the business owe, what they have to pay back at a point in time. Now, if the business owner or one of the shareholders decides to remove part of their capital in the business, that means the capital is reduced. That is why we put it on this side. I hope we understand. So let's sum up this back. Let's go back to class. Let's sum this up. Summing this up, we have 159,000. Summing this also, we have 159,000. So if you notice, both sides are equal. Remember, we said earlier, our assets equals capital plus liabilities. So this total of our assets here is giving our capital plus our liabilities. So at any point in time, this account should be balanced like this. So let's give a scenario. Now, we have this account like this. Let's say in the course of the year, Adef Pure Water Factory decided to pay, he paid his creditors in cash. Okay. Let's say then he now paid his loan. He paid part of his loan to bank. in check. He paid his creditors in cash to sum of 9,000. So he paid all of his creditor. Then he paid the sum of 2,000 naira to bank. Now, out of his stock, he now sold. He sold 5,000 naira. Worth of goods to Damilare. Let's see how it's going to affect this. So let's pick the first one. He paid his creditors in cash the sum of 9,000 naira. So that means his cash is going to reduce. His cash is not going to be. There's no much space here. So I'll work with what we already have. I don't want to clean this part. Well, okay, let me just clean it so I will understand better. Okay, so let's see. Extract balance sheet for Ade Pure Water Factory as at 31st March 2026. So let's go back now. Let's put our Naira sign here. Our Naira sign here. So let's start again. Our capital 130,000. Then our equipment is what? It's an asset. It comes here. Equipment 90,000. Our creditors are coming here. 9,000. Our stock is 15,500. But remember here, he sold part of it worth 5,000 to Damilare. So let's say 15,500 minus 5,000. What are we going to have? We are going to have minus. We are going to have 10,500 left. Earlier, I said his creditors is 9,000. But remember here, he paid his creditor in cash, the sum of 9,000. So that means he does not have creditors again. What's now going to happen? Our cash was 50,000 naira before, minus the 9,000 naira he paid to his creditors. We have 41,000 naira left. I hope you are getting. Then the bank also, he paid part of his loan to bank in check. He paid the sum of 2,000 naira. So our bank, we had 3,500 in bank before, minus 2,000 naira. Our balance is now 1,500. Then let's now come here. Loan from bank. Remember, he was owing 20,000 before. Now we paid part of it. He paid 2,000 out of it. So loan to bank 20,000 minus 2,000. We have a balance of 18,000 left. Let's now sum up if we will be arriving at the same balance. Let me make this line here. We have 148,000 naira. We also have 148,000 naira. So this is what I want us to understand, that no matter what is going to happen during the year, no matter the changing, the sales, the increase in credit, the increase in debit, or whatever is going to happen, these two sides must be balanced. Just because we say our assets, which is on this side, equals our capital plus liabilities. Thank you. See you in the next class. Bye.